So thank you very much for joining the meeting. I know that there are a few more people that are going to be joining as we go along with the training. So on the call, in terms of the presenters today, we have our partners, our brokers, who are also members of the VFEX team VCG. We have got Emmanuel and Shauna. So as VFEX, we are just going to emphasize on the fact that we are the regulator of CFDs, what you can also call forex trading. And our role in this is mainly to make sure that the clients or the customer, the investors, which are most of the attendees here or who are going to be our future investors, are kept safe when it comes to investment options. The first major thing that we'll be looking at as VFX to keep you safe is to cover what we call the exposure. When we say we're covering your exposure, it means that when you open a position or when you think to say that today you now want to invest using VCG to buy or to participate in the forex trading market, you invest $100, and your $100 is going to come back as give or take maybe 150. So let's just say then VCG is not able to cover that obligation. We as the VFEX have put in a collateral where these funds are always they're always vetted and pegged with the exposure of VCG, meaning that the 150 that you have put in, if VCG is not able to cover that obligation, VFX will have the right to go to the collateral account and then dispense the funds accordingly. So at the end of the day, we're simply saying VFEX and VCG's partnership will always make sure that the investor is always covered no matter what. So with that regard, it then means that when you're investing, you always know that you are safe with regards to the funds always coming to you if you're in a winning position. We're also there to look at the rules and regulations and to monitor all the activities that VCG are doing. As the regulator, we also have access to the platform where we'll be able to monitor all activities and make sure that they're within the regulation and rules that have been set. So that being said, I would like to allow the broker from VCG to give us an introduction about VCG, and then from there we'll then get into the actual training of the CFD slash forex trading. So I'm just going to hand over the space to Emmanuel. Emmanuel, can you take over?
All right, thank you so much, Edmund. Good morning, everyone. I hope everyone is well. So my name is Emmanuel, and I am part of the VCG team. So today, what we will be doing is for our presentation as VCG, we will be tackling some of the most frequently asked questions that we receive from clients before they do decide to invest with us. So let me just share my screen. All right, can everybody see my screen?
Yeah, it's visible.
All right, fantastic. All right, so some of the frequently asked questions that we do receive, one of the major ones is, what type of a broker are you? So we as VCG are a CFD broker, CFD standing for Contract for Differences. So a contract for difference essentially is just one of those popular trading instruments that allows traders or investors to speculate on the price movement of assets without actually owning the underlying asset. So just a simple breakdown or maybe the purpose of a CFD. A CFD essentially enables traders to profit from price fluctuations in the financial markets. Another question that we do receive is, why trade CFDs? So there are a few benefits. First being the leverage, where you can trade with more than your initial investment. You can also profit from the falling prices, which is short selling. And you also have access to a wide range of markets. But key points to remember, especially with CFDs, the first being leverage. So although the leverage can amplify your profits, it is also important to know that it can also amplify your losses. The second point to note is that you do not own any asset. You are just simply speculating on the price changes. And the third and most important point to note is your risk management. So it is very important and essential for you to use stop loss orders to manage your risk, because it would then not be advisable for you to then enter a trade without actually applying proper risk management, because uh, you will have sort of like the chance to, or you'll be running a chance of blowing your account. How do CFDs work? So there are a few ways. One of them is a trader can choose an asset. For instance, let's just choose a product like your stocks. And then you then decide whether you think that the price is going to go up or go down. Hence the speculating aspect. And then the leverage. So this also allows you as a client or a trader to trade on margin, meaning that you can open a position with a small deposit compared to the total value of the trade. As for your profits or losses, if the price does move in your favor, you then make a profit. But if it doesn't, then you will incur a loss. So just to summarize CFDs, so CFDs are essentially just a flexible and potentially profitable way for you to trade on the price movements in the various markets. But they also do come with many risks as well. So that is just something you'll have to note before you then venture into CFD trading. So what products do we offer? So we have your stocks or shares. We have examples such as your Microsoft, currencies, also known as Forex. You do have your Euro USD, your precious metals. You do have gold, your indices. You do have Dow Jones, cryptocurrencies. You do have Bitcoin. Are there any inactivity fees? So this question usually arises from clients that would have traded with other brokers before. So with us, no, you do not have any inactivity fees. So I do believe this question arises when, if you've ever traded with another broker before. So the thing is, whenever you go for a certain period of time without trading, either your account is deleted and then you'll have to recreate that account again, or some of the brokers do charge you inactivity fees. So with us, you can go for a month, 2 months, and we will not charge you anything. You just start from where you left off. So even if your account had, let's say, $3, let's say you traded in September and then you then stopped for some odd reason, whenever you do come back, we will not charge you anything. Just continue from where you left off. And this is one of the most fascinating questions that we do receive as a broker. So some clients do ask us, how do I determine if trading is suitable for me? So before engaging in trading, we do advise clients to first do an internal analysis of themselves. So first thing, you should consider your risk tolerance. So you should decide how much volatility and potential loss you can handle without impacting your emotional well-being. As for the investment aspect, your investment goals, you need to establish clear and realistic objectives that align with your timeline and financial aspirations. And then for your financial situation, and this is the most important part, you need to ensure that you have a clear picture of your finances so that you don't over leverage or over invest money you cannot afford to lose. So usually we do receive clients that would tell us that, I only have $50. So what will happen if by some, um, unexpected chance that I do blow my account? So usually this is a very important question to ask yourself before you start CFD trading, because with us, by considering that factor, if this is money you're not willing to lose, then CFD trading might not be for you. However, it is a 50-50 uh, chance. There's a 50-50 chance whereby you'll be able to also multiply that money that you'll be left with. But at the end of the day, your well-being is important. So if you're someone who might react in a negative way after you lose that $50, chances are CFD trading might not be for you. So by considering these factors, you need to be able to make more informed decisions that align with your personal circumstances. So that is your risk tolerance, your investment goals, and also understanding your financial situation. So with this as well, once you understand your financial situation, risk tolerance, and also investment goals, you'll be able to tackle this quiz. So this is something we do tend to ask clients, especially the ones that are new with us. What are your primary trading goals? Are you in this for wealth accumulation, or is it a retirement plan? Are you in it for short-term gains, or is this for income generation? So all these questions can only be answered by you as an individual that would want to divulge in the CFD trading markets. And this is one of my favorite questions. So how much money can I make if I'm to be trading with you? So this depends on the person. So remember, I spoke about your risk tolerance and also your investment goals. So let me just give an example. Let's say Edmund and I are to be investing $100 each. But then at the end of the day, it might seem like we are starting on a clean slate and we're starting on equal footing. But the thing is, we're different in the sense that I might be someone who has low risk tolerance. So with my $100, chances are if I lose that $100, I might not be able to recoup that $100. It might take me a while to then, let's say, hustle and then get another $100 to then invest. But with Edmund, let's say his $100, it's an make it or break it situation. If he loses the money, he won't feel any type of way. But if he does make it, then it's a win-win for him. So knowing your risk tolerance and also your investment goals, this will be able then to help you determine how much money you can make with trading. Because I'm someone who might not be able to recoup the $100, chances are I'm gonna be applying proper risk management when I'm trading. So on that $100 account, chances I'll be making $1 a day, $2 a day, and I'll be content because my end goal is not to blow the account, but to grow it gradually. But with Edmond, it might be different. For him, it's a make or break situation, and because he knows that it's investment, he can either win or lose. So with him now, the way he approaches trading will be different from the way I will approach trading. And I do recall Teacher on in the last session, he did talk about the types of traders. So I might fall under uh, a cautious trader. Those are usually called swing traders for the most part. And then Edmund might fall under aggressive traders or scalpers. So with him, with his $100, he might make $100 extra, either on a daily basis or on a weekly basis, or he might lose that amount. But either way, the amount of money he makes is different from the amount of money I will make. So to answer this question, how much money can I make if I trade with you? It all depends on you as an individual. So I did ask a few clients to provide us with a few screenshots of their trades so that I can give you sort of like an illustration. So with this, I think you can see from my screen, you see the different profits that are being made from these traders. So for the most part, the traders that gave us the screenshots were scalpers. And as you can see, they open a lot of positions. So these guys do not implement proper risk management because they want to make a lot of money in a short period of time. So of course, their lot sizes they'll be using the lower lot sizes, but if their positions reach a certain target, then they'll close. Like with the first trader from the first screenshot, he made $181, and as you can see, he opened many positions. So this was over leveraging. But as you can see, each position was in a dollar profit, so you can then calculate the number of positions that he opened. The second trader, as you can see, he made $159, but then with his positions now, his profits were in cents. So he opened a lot of positions to be able to then reach that $159. So you can imagine if the trade had gone the opposite direction, all of these accounts most probably would have blown. So these guys are scalpers, so they're willing to risk it all to either win or lose. Chances are, of course, they'll be in the game to win, but they would understand then the risk that if I do blow my account, it's okay. I can always come back with another deposit and try again. And if you see from the third screenshot, so this person opened only three positions. And although his lot size is zero point 0.1, but he was still trying to implement proper risk management. He wasn't trying to open many positions where he couldn't manage, because if his positions were to go the opposite direction, he'll be able to close them uh, a bit quicker than someone who would be trying to close all these many positions. So this person will be able to then manage their risk, or at least manage their position. So these are scalpers. If I do get for the next session, when I do get traders or one of our clients that do implement proper risk management, I'll be able to then show you what it's like, just to illustrate my point that your profits are dependent on your personality and also your risk tolerance. Do we trade for people? So the answer is no, we do not. But we do offer a copy trading service under our VCG social platform, where you can then choose your trader. We do have a pool of over 400 traders, so you can just choose a trader based on their performance. And if you're satisfied with that performance, you would then click on the copy icon that will be on your screen, and then your account will be copying that trader's exact moves automatically. That is by opening and closing accounts. So another question that we do receive is from clients is how and where can we access your trading products? So for us now as VCG, we do have three ways in which you can access our products. Firstly, from our copy trading service or our platform VCG Social, you'll be able to then get all the products from there. For the clients that have been trading using MetaTrader 4, you then just have to upgrade to MetaTrader 5, and then you'll be able to access our platform and also our products. And then we do have our app, a VCG Markets Trading app, where you can also access our products as well. Sorry, before I continue, I do see that there are a few raised hands. So I'll just answer your questions after the presentation. Another question that we do receive is, how do I deposit? So whenever you create an account with us, an account manager is assigned to you. So you would then simply reach out to your account manager, and they'll be able to assist you in making a deposit by generating a deposit link from our bank. As for how long it takes for withdrawals to reflect to your account, so if you deposit using Visa or MasterCard, it would take roughly 2 to 3 business days for your withdrawal to reflect in your account. If you were using bank transfer, you receive the money the same day, same as EcoCash. So this is one of the most popular questions we've been receiving as of the last 2 months or so. Is it too late to start trading? So it's never too late to start trading. Yes, you may have missed a few opportunities here and there, but that does not mean that, there won't be any more opportunities for you to tackle the markets. So for this, I can give an example. I do believe this year we've all seen that Bitcoin, gold, and Nvidia have been performing quite well. So these three products have been performing exceptionally well this year. In as much as you may have missed the trading these products this year, that does not necessarily mean that you won't get more opportunities in the future. There are other products that will perform well, especially come 2025, that will be able to, just grasp on that opportunity and ride the wave. So just to illustrate the performance of these three products. So firstly, with Bitcoin, this is the yearly chart beginning Feb. So as you can see, it did go on a decline. I think that was during the August period. But after that, it was performing quite well. And right now, Bitcoin is at an all-time high. Same thing with gold. If you had started trading beginning of the year, I'm sure by now you would have made significant profits. Nvidia as well. So all these products performed, but that doesn't mean that you missed. This is the only opportunity that you missed. Come 2025, Bitcoin and gold are still going to perform well. They're going to break their all-time highs. So you still get more opportunities to trade these products. And I would like to believe that some products will perform well. Um, and I think we'll be giving market updates beginning 2025, whereby at least all the clients will be able to they now know which products are performing, which products, uh, are upcoming, where you'll be able to at least make an informed decision on which products you like to trade in the future. So just before I end this off, I do have a quote that I would like to share with you from Warren Buffett. So it says that whenever you like to venture into trading, please remember that uh, successful investing takes time, discipline, and patience. And also another quote from Robert Arnold. He once said that in investing, what is comfortable is really profitable. So this is just something that you can take home with you so that you'll be able to know, just digest it and see if maybe CFD trading might be for you. But even if you do decide to start trading with us, with our platform and with our team, with our account managers, they'll be able to at least guide you on how you can go about to start trading. Whatever questions you may have, will be able to assist you so that you will not have any doubts about CFD trading. Thank you so much.
Thank you, Mayo. Thank you very much for that presentation. I think before we move on to John, I think there are a few hands up, so maybe you could just, if there are any questions, you can raise your hand and then we'll just call you out so that you can then speak. Are there any questions on this presentation that Manu has given us? Kindly also note that we're going to share the presentation with you. We do have your emails based on the registration that you've done, so we're going to share the presentation with you as well as the video that's also being recorded right now. We'll share that. When this I see you've got your hand up, you can go ahead and ask your question.
Can you hear me?
Yes, we can hear you. Go ahead.
Oh, hey, how are you doing? Hey, quick question. I trade on the US stock exchange over here in the States, and I was wondering what other assets are you, because you mentioned Nvidia, Bitcoin. Are there any other assets like Tesla, other stocks, Tesla or anything? Are you using the same, are you trading the same things?
Yes, we do have other products like your Tesla, Netflix, Apple. We do have a lot of products, over 700. So especially if you're someone interested in trading stocks, I do believe we may have the things that you'd want to trade, but we do have a lot of products on offer.
Oh, okay. Oh, thank you. Thank you. Thank you.
Thank you for the question. Anyone else before we go to the actual training? All right, great. I think this time, I think I'll just give this time to Jonah to then take us through the actual CFD slash Forex trading training. You can go ahead, John.
Sure thing. Thank you, Edmund. Thank you, Emmanuel. My name is Tichona, and I'll be leading you in today's training session. So let me share my screen. Okay, I hope my screen is visible.
It's
Not
coming up.
yet.
Not yet. It's coming up.
Okay.
Yeah, we can see your screen now.
Yeah.
Lovely. So essentially today we are going to look at we're going to touch on market structure, technical analysis, and the psychology behind trading. And later on, we will do our Q&A session. So the first question is, what is market structure? So basically, market structure these are the characteristics of a market which influence how prices are determined and how trading takes place in the financial markets. So there are key aspects to look at when you're looking at market structure. First, we look at the price action. We look at the trends, whether the price is going up, it's going down, or going sideways. We also look at the market participants in the financial markets. We also look at the market conditions and support and resistance levels. So when it comes to price action, basically with price action, this is the movement of prices over time, reflecting the supply and demand dynamics. So basically, for example, when we open our MetaTrader 5 application, when we see these red and green candlesticks, basically these are showing us how buyers and sellers are interacting in the market. So currently we're looking at a gold chart on the 4-hour time frame. So from the previous training session, the red candlesticks that you see indicate that the price is going down, meaning that there are more sellers in the market. And when you see a green candlesticks, it shows that there are more buyers in the market. So with price action, this is basically an interplay between supply and demand. So whenever at a moment there are more, let's take for example, maybe there are more buyers in the market for a given financial instrument, we would expect the price to go up, and vice versa. When there are more sellers in the market, we would expect for the price to go down. Going back to my presentation. We also look at trends. There's a very common phrase that we use in the trading sphere, whereby we say that the trend is your friend. When trading, you always want to trade with the trend. So we have 3 common trends that we find. We have what we call an uptrend, a downtrend, and a sideways trend. So essentially with an uptrend, this is a sequence of higher highs and higher lows indicating bullish sentiment. So basically when the market is bullish, when it's going up, we would expect to see a series of higher highs and higher lows. One might ask, what does this look like? In an uptrend, you would expect to see a low indicated down below here, then a higher high above, then the price would retrace down to create what we call a higher low and continue upwards. So essentially in an uptrend, you would see a series of higher highs and higher lows as market makes its way upwards. Chart would show something like this, something similar to this, whereby you would see more green candles as compared to red candles. So we have a downtrend, which is basically the opposite of an uptrend, whereby we would be seeing a sequence of lower highs and lower lows, indicating bearish sentiment. So we would expect to see here a high. Then as price makes its way downwards, we would see a lower low. Price would then retrace upwards just a bit and then continue going downwards. A typical chart example would look like something like this. Okay. Let me toggle back to the MetaTrader 5 application. Okay. Okay. Typically for an uptrend, we have an example here that I'm highlighting. Here we see that this is on the gold chart on the 4-hour time frame. We see that price started down below here and started to making a series of higher highs and higher lows as it made its way upwards up to this level, to this top level here at 2,723.49. So essentially, when you see the market trending like this, you would want to get into your positions, which would be buy positions. So as price continues to go upwards, you would continue to see your profits coming in, and vice versa. Let's try to open another chart and see if we can find a downtrend. Okay. Okay, let me open the Euro USD and go backwards just a bit. Okay, lovely. So let me highlight. Okay, so the area here I'm highlighting would indicate a downtrend, which started here on this top level at 1.125. This is the price of the euro against the US dollar, which is a currency, one of the products that we provide on our platform. So typically, you would, in a downtrend, you would see the lower lows and the lower highs as price makes its way downwards. So in a trending market like this, you would want to get into sales and continue and ride the trend downwards. So we also have another trend that we call a sideways trend. It's also called consolidation or a ranging trend. So basically, this is a range-bound market where prices move within a specific range. So price would appear as if it's not moving or it's stagnant at a certain price level. So typically, price will be moving in a horizontal zigzag manner, as we see in the slide. So on a chart example would look something like this, whereby price acts as if it's bound by this line on the top and this line on the bottom. If we were to open our MetaTrader 5 application, which we use to open and close positions, let me open another financial instrument. I'll open the US. Let me open gold, the gold dollar. Typically, it would look something like this over here. Let me highlight it and use a different color. Here we use blue. Yeah, indicated by this blue rectangle. We can see that price is bound within this box and it acts as if it's not going upwards or not going downwards. So typically with the ranging market, you would want to avoid trading in such circumstances, as you'll be not sure whether the price is going up or going downwards. So when trading, you would actually wait for price to break through this level and indicate whether it's in an uptrend or downtrend and start to look for positions you can enter. This is for a sideways trend. We also have another key component of market structure that we look at, whereby we look at the market participants. These are the people that we find who will be active in the financial markets. So we have central banks, we also have commercial banks, institutional investors, retail traders, big and small corporations, your brokers such as VCG markets, and speculators. So these are people who would just be, we take advantage of price fluctuations, then take their profits and try to look for another opportunity. So the hierarchy would look something like this, with major banks at the top, because usually major banks, when they trade, they enter with large volumes of amount of capital. Then we also have our electronic brokering services, your EBS. These are your top brokers who deal with the major banks. Then we have our medium-sized and small banks. These are your commercial banks and your local small banks that you see. Then down below, we have our retail market makers, our hedge funds, our commercial companies. So essentially, market makers this can be firms or individuals who have large amounts of capital and who would take advantage of price fluctuations in the financial markets. And down below, indicated by the green area, retail traders. That's where most of us, you and me, the normal guys, fall in. So there are also market conditions that we have to be alert of, that we have to take note of. We would look at volatility, which is the degree of variation in trading prices over time. We also look at liquidity, which is the ease at which an asset can be bought or sold in the market without affecting its price. So this is essentially what makes it easy for you to get into a position and get out easily, instantly, if I might say. We also look at market sentiment, which is the overall attitudes of traders towards a particular market. Then also, there are also important factors like the economic data releases. These are reports on economic indicators such as your GDP, your CPI, which is for inflation, and etc. We also look at geopolitical events, whereby we look at political instability, conflicts, or significant policy changes. This can be maybe wars, especially like the war that is in Israel right now. This is something that is actually affecting the financial markets. Then we also look at interest rates, the cost of borrowing money, which is set by the central banks. So typically when trading, there are two types of analysis. We have what we call fundamental analysis, whereby we mainly look at the geopolitical events and basically your news. And we have what we call technical analysis. So essentially with technical analysis, you'll be evaluating the currency price movements and trends by using historical data, charts, and indicators to forecast future market behavior. So this is what we mainly use, especially when we are using the MetaTrader 5 application. So there are key principles when using technical analysis. The first one being that the market discounts everything. This is simply to say that when we look at the chart and look at the price, we are saying that the price should reflect all the available information that is happening in the financial markets for a given financial instrument that we're looking at. We also look at the price moves and trends, as I was iterating earlier on, whereby we're looking at whether the market is in an uptrend, a downtrend, or a sideways trend. And also, a key aspect of technical analysis is that history has a tendency of repeating itself. So market psychology influences price movements, leading to recurring patterns. So these recurring patterns are what we normally look for when we're analyzing the charts, so that we could maximize on them and enter into a position. So we have what we call support and resistance. So typically with support and resistance, a support level, this is a price level where buying interest is strong enough to prevent further decline of price. And whilst a resistance level, this is a price level where selling interest is strong enough to prevent further increase. Is typically called a price ceiling, and the support is typically called a price floor. So for you to see this a bit better, let me go to another chart. Okay. This is the US dollar, Canadian dollar chart, another currency. So typically what we're saying with support and resistance, we would look at the top part here where I'm placing this black line. This would be our resistance. Whilst our support, I would place it down below here. This would be our support area. So clearly, from what we can see is price started, yeah, let me indicate by the screen line, started around here. It broke through our support level and continued going upwards until it reached the resistance level on top, which I've placed at this level at 1.42442. So essentially with resistance levels, we are saying that there's a lot of selling interest at these levels, such that when the price reaches this level, it has a tendency of bouncing off this level and changing, reversing its direction. So if price was going in an uptrend, as in this case here, before the green line, that the vertical green line I've placed here, it continued going upwards until it reached this resistance level, and it bounced off this resistance level and started going downwards towards our support level. Vice versa for our support level, which is our price flow. Price reached here and then it bounced off this level and started going upwards towards our resistance level. So essentially, these are very important levels when trading a given financial instruments, and they can be used to help us enter and exit our positions. So support and resistance, as I was iterating before, we have our resistance by the red, this is indicated by the red line on top, and our support at the bottom. So typically when drawing a support level, the more a support level is tested, what I mean by tested is the more that it is price reaches this level and bounces off of it, the stronger it becomes. So next time when we see that price is approaching the support level after it has been tested multiple times, there will be a high probability that price will bounce off of the support level and reverse in the opposite direction. Okay. Let me find another chart. We can use maybe the British pound and the Japanese yen. Let me change it for it to be a bit clearer. Nice. So here, to place our support and resistance, we'll just look at the top part, which is somewhere here, and we would place right above here. As we can see, from our resistance level has been touched 3 times, indicated by these wicks on these candlesticks. Then for our support level, you could place it maybe somewhere around here, or maybe a bit down. Somewhere around here. So the expectation would be for price to bounce off our support level and make its way towards the resistance level on top. But it is important to note that our support and resistance levels are not just a price level, a definite price level that you see, like here at our support level is at 195.082. Typically, support and resistance levels can be zones. This can be an area. So you might find there are situations whereby price might reach your line here, but it will go down just a bit and then bounce off and start going upwards. So it doesn't mean that your support level has been invalidated. Basically, we're just saying that it will be an area that we should look at. So going back to our chart, yeah, like here on our slide, we have our support line here, but we have this blue area here which shows us our support area. So we would typically expect that when price reaches this area, anywhere within this area, our support area would be respected and price will bounce off of this level. So there are mainly two ways of trading support and resistance. The first way is what we say trading the bounce. As I was saying earlier, this is when we expect price to bounce off of our levels. So when we're buying, we are saying that when price reaches the support area, we expect it to turn around and start going upwards. And vice versa, when price reaches our resistance level, we'd expect it to start selling and going downwards, which would look something like this. With your support level here, price makes its way down below, it retests the support level and makes its way upwards. So typically when trading the bounce, you do not want to enter to place your buy on the line to be exact. You would want to wait for what we call a confirmation that price has truly bounced off of this level. So you would actually wait for a bit for price to bounce off of this level and then enter your position a bit higher, somewhere around here where it's denoted entry order. Then when placing your stop loss, you just place it somewhere below the support level. So your stop loss, essentially, this is a level that we place when we want to mitigate our losses, provided that price hasn't gone in our favor. Whenever price reaches this stop loss level, it will automatically close the trade, thereby protecting our funds and capital. So when trading the break, support and resistance levels aren't indefinite. There are times when they can break and price can continue going whether downwards or upwards. So typically when trading a break, we're saying that when you are in a bullish position, we're saying that you would want to place your buy position just above the resistance level. And when you are selling, you would place it just below the support level. Like this. So there are two approaches when trading support or resistance level break. We have what we call the aggressive approach and we have what we call the conservative approach. So with the aggressive approach, the moment that you see that price is broken through your support level, you would immediately enter your position. You would enter your sell position. And if price continues going downwards, you'd start to see profits accumulating in your trading account. And vice versa. If price were to reach your resistance level, you would place your buy position, and if price continues going upwards, you'd see profits accruing in your trading account. Then with the conservative approach, typically when you see that price is broken, your support level, which is in this instance, you would want to wait a bit and wait for price to come back to this level, to this support level and bounce off of it. So there's a tendency when, for example, when a support level is broken, sometimes a support level can turn into a resistance level, as in this circumstance, where price indicated by this green line here, it broke the support level and it came back to the support level, which had turned into a resistance level and then continued downwards. So you would, this is a more conservative approach because sometimes, as I was saying earlier on, a support level can be an area. So uh, you might be too quick to enter your position at this level, support level, with a sell. Then price comes down just a bit and then continues going upwards. So you'd start to accrue some losses if you would follow that approach. So typically we advise traders who are still starting out to try the conservative approach, as it is more safer as compared with being more aggressive when trading. We also have trend lines. So basically with trend lines, this is a straight line that connects two or more price points, acting as a visual guide to indicate the direction of a currency pair's trade. So essentially trend lines help us to see the general trend, how the market is moving, whether it's going upwards, it's going downwards, or it's in a sideways trend. So essentially, we have mainly two types of trend lines. We have what we call an uptrend line, which is here. So it would look something like this, whereby you would be connecting these lower highs. And then we have what we call a downtrend line, which you would see here connecting these higher lows. So on a chart, it would look something similar to this. So the blue lines indicate an uptrend line, whilst the red line indicates a downtrend line. So with these uptrend lines and downtrend lines, typically you just need to join 2 points and then extend the line. I think it's better if I show you on a chart. Let me open maybe go. This is the Australian dollar Japanese yen chart. So typically this area here, which is a downtrend, is highlighted by the lower highs and lower lows. You would want to come here upwards and select this trend line here. You just right click here and then you would go to the top part, click on it and extend this line downwards. Okay. So this is essentially our trend line. So like our trend line, this is more or less similar to our support and resistance line. The expectation would be when price reaches this level, there will be a high probability that price would bounce off of that trend line. But also like support and resistance levels, they can also be broken. So meaning to say that both the conservative and aggressive approach that we were using in the support and resistance lines also applies here. Let me try to find another one. Maybe if we go to the gold chart, let's go a bit back. Okay. Let's go a bit back. Okay, maybe we could use this area here. So you would go to your trend line, click on it. Go, in this case, this is an uptrend line. You just only need to connect two parts, which in this case, my first part was down below here. And this part here. And then I would extend it upwards. So this is typically what your trend line would look like. In this circumstance, the trend line was eventually broken here at this level. and then price continued going in a sideways manner. Okay. So typically what I was saying that the trend lines are similar to your support and resistance levels, whereby they can be, you can trade the bounce or you can trade the break. So when trading the bounce, you would want to wait for price to confirm that it has reversed its direction. So your entry point would be somewhere down below and not exactly on the trend line itself. So you would place it somewhere below here, and you would place your stop loss just above, just in case if price doesn't go in your favor. So we're saying that if you're putting your sell position, you're expecting the price should continue going lower, you would place your entry order here, and then your stop loss would place it above here. This is for your trend line. We also have what we call candlestick patterns. So with candlestick patterns, basically we use these in conjunction with your support and resistance lines to find better entries. So it's like they add an extra layer of confirmation to your trading. So we have bullish candlestick patterns and we have bearish candlestick patterns. With the bullish candlestick patterns, essentially we would expect price to go upwards when we see candlesticks like this. For instance, here we have what we call a hammer, typically because it kind of looks like a hammer. So in a situation whereby you see this candlestick pattern at a support level, you would have extra confirmation that you could place your buys and you can then start to see your profits accruing in your trading account. And also vice versa, with the bearish candlestick, here maybe look at the bearish engulfing, the second one here. When you see this type of candlestick at a resistance level, that means you would have two confirmations that the market might go downwards. So you would be looking to enter into sales for the financial instrument that you'll be looking at. So these are your typical candlestick patterns. They're actually quite a lot. So for simplicity, usually if you can just download the cheat sheet, which just shows everything, it will be much simpler than memorizing every candlestick pattern. Okay. Alongside our alongside our chart patterns, our candlestick patterns, sorry, we have what we call chart patterns. So typically with chart patterns, we have various types. We have what we call continuation chart patterns and reversal chart patterns. Continuous chart patterns meaning that we would expect price to continue in the direction that it's going. So we're saying that if price was bullish, when we see a typical continuation chart pattern, we'd expect the price to continue being bullish and vice versa. If price was going downwards in a bearish manner, we'd expect price to continue going downwards. So we have common chart patterns like your head and shoulders and your double top. So your head and shoulders is typically a reversal chart pattern, which would look something like this here, whereby you would have your left shoulder here, you have the head, which is the top part, and you have your right shoulder. And here at the base, you have what we call our neckline. So whenever you see a pattern like this on the charts, typically you would expect for a reversal in the price. So in this case, price was a bit bullish. It was going upwards, and then we would expect now to price for it to go downwards. So typically when trading a head and shoulders pattern, you would want to place your trade position just below the neckline. you would want to see an aggressive break of this neckline, which will be acting somewhat similar to a support level. So whenever you see your neckline being broken, you could just start to enter your sell positions, and you would want to hold them up to maybe somewhere down below here, where you would typically place another support level there. We also have another common chart pattern, which is a double top, whereby you would see two peaks. So essentially, when you see a double top, this is also a reversal chart pattern. And similarly, like to the head and shoulders chart pattern we saw earlier on, you would want to place your trades just below the neckline. So you would place your sell position just below the neckline, and then you would ride the trend downwards and start to see profits accumulating in your account. Let's try to check if we can find one of these patterns on the charts. Okay, let me open. Okay. This is the Great British Pound, Japanese Yen. Okay, let me try maybe on gold, the gold chart. Here we actually have something similar to a head and shoulders. Let me highlight it for you. This area I have highlighted, whereby we have our left shoulder here, we have our head, which is the top part, and we have our right shoulder. Then let me place the neckline, which is somewhere below here. So this is your typical head and shoulders chart pattern. So as in this case, if we saw that price has broken this level and waited for the next candlestick to form to enter our sales, would have been in profit. As we can see, price is continuing going downwards, so we would have made a profit if we had entered this trade. So for your price, you would have entered it somewhere around here, which I'm indicating by this line here, this red line here. That is for your head and shoulders chart pattern. We also have what we call technical indicators. So basically with technical indicators, these are tools that can be used to monitor price trends and attempt to predict future price action. So there are a lot of technical indicators that we can find on the MetaTrader 5 application, which you could use the PC version or download the mobile version. So, but today I'm going to look at just two. We will look at what we call moving averages and your relative strength index. So essentially with your moving average, this is a trend following indicator that smooths price data to identify the direction of the trend. This is simply to say with the moving average, you'll be just trying to identify the direction of a trend, whether you would want to check whether the financial instrument that you're looking at is in an uptrend or downtrend, or it's in a sideways trend. So we have two types of moving averages. We have what we call a simple moving average, which is the average price over a specified period. So essentially what a moving average tries to do, it just tries to find the average. It takes the closing price of the financial instrument that you'll be looking at, and it takes the average prices over a set period. So you have the ability to actually choose the period that you want, whether it's at a 5 minute interval, a 1 day interval, maybe a 15-minute interval. So it will just take the average. So this helps to filter out a lot of noise, because as I'm sure you've seen, or when you look at a chart, let me open maybe the Tesla weekly chart. As you can see, there's a lot of noise here with your candlestick and your wicks. So with a simple moving average, it tries to filter this noise out and smoothen the price. Then we also have what we call an exponential moving average. So essentially with an exponential moving average, this tries to give more weight to recent prices for quicker responses. So this exponential moving average tries to pay particular attention to current price rather than the previous price. So you would find that as compared with the simple moving average, which takes the overall average of the price of the specific time interval that you would have chosen, this one tends to be more reactive, as I will show you in a bit. So typically on a chart, your simple moving average and your exponential moving average would look something like this, with the red line here indicating the exponential moving average and the blue line indicating the simple moving average. So the simple moving average tends to move a bit slower relative to the price as compared with the exponential moving average, which is more reactive to price movements. So when placing these on our Tesla weekly chart, we would go here where it says insert, right click, go on to indicators, then you would select oscillators down below here, and then search for moving averages. Okay, which is here. Okay. This one is a bit different. Let me go back. Indicator. You would go to trend, sorry, not oscillator. You would go to trend and then go where it says moving average here. So as we can see here where it says period, you would have the ability to choose the period that you would want to use. In this case, we are looking at the weekly chart. So if I put 4, this is simply to say that it would take the average of 4 weeks. So each candlestick here on this chart indicates 1 week. So on method, you would choose simple, you would apply to the closing price. Then style, this is the color that you would want to use for your moving average. You click OK. So as you can see, this is our moving average here, which is indicated by this green line. This is our simple moving average. To place our exponential moving average, we'll do the same thing. We go to insert, indicator, down here to trends, and then moving average. Okay. Instead of, on the method, instead of simple, you would then choose exponential. And then maybe we can choose another color for visibility. Maybe you can choose red. Apply OK. So I hope it's visible. Let me try to enlarge it. Yeah. So it will look something a bit similar to this, with your red line being your exponential moving average and your green line being your simple moving average. Okay. So one might ask, how do I trade using these moving averages? So there are basically a number of ways of trading using these moving averages. There's what we call trend confirmation. So with trend confirmation, typically when you see prices above your moving average, this can indicate an uptrend. Let's go back to the chart. Maybe let's choose another one, another asset. We can try the Australian dollar, Swiss franc. Okay, here we already have a moving average. This one is the 14 period simple moving average. Let me thicken it a bit for visibility. Yeah, nice. So typically when trading using a simple moving average for trend, when you see price above this red line here, typically you would be looking for buy positions, as it would indicate that the market would be bullish. And when you see price below this level, this red level, that's when you typically want to look at sell positions. So usually when trading using this trend, trying to follow the trend, you would want to use higher periods. So maybe we could use the 50, which would be a bit better. So as you can see from this area here, price was above our red simple 50 interval moving average and has been bullish for a while. And here it was tested for a bit and price continued going upwards since it is still above this level. Conversely, if price was below this red line, would be looking for sell positions. Okay, here's an example with the 30 simple moving average, whereby we can see that price was above this purple line here, and as well we can see that it was making consecutive higher highs and higher lows, indicating further confirming that this was in an uptrend. So essentially with trading, what you would want to do is have multiple confirmations, which would further reinforce your position. So whether in this case, if you were entering a buy, you have higher highs and higher lows to indicate that this is already an uptrend. And you as well, you can see that the price is above the simple 30 simple moving average, further confirming that you should hold your buy positions. We using moving averages, we also have what we call crossovers, whereby for a bullish signal, you would want the short-term moving average to cross above the longer-term moving average. So typically with this type of trading style, you would have two moving averages, a lower one, which is of shorter term, and a higher one of a longer term. So it would look something like this, with your blue line indicating your 10 SMA, which is your simple moving average, and your red line indicating your 20 SMA, your 20 period simple moving average. So whenever, in this case, price crosses over, in this case, the red line, the 20 SMA crosses over the lower one, the 10 SMA, you would look to get into sell positions. So you would typically place it just below when you have seen a crossover, and place your position and then ride this trend. And then you just start to see profits accruing in your trading account. Alternatively, if the 20 SMA was to cross over the 10 SMA with the blue SMA going close to price, you would want to enter buy positions. So a simple way to actually see this is if the lower simple moving average is closer to price, you would expect to get into sales. Then if the higher SMA is close to price, you would typically want to look for buy positions. Maybe we could try to do this on the chart. We can place another moving average here. Go to indicator, trend, moving average. Select, we had chosen the 50, maybe we could place the 100. Choose maybe a different color, blue. For example here. So here we see that there's a crossover. Here. So typically when you see this crossover, you would want to start for looking for buy positions. Maybe you would wait for price to move just a little bit, and then you would hold the trend. And then you would start to see your profits accruing in your trading account. Let's look at, we can see as for a sell condition. Here we have a sell condition. Where price crossed over. So whenever you saw this crossover, you would wait for just a little bit, and then you would look to enter sell positions and ride this trend downwards. So we also have what we call the relative strength index. So with this indicator, typically you would be measuring the speed and change of price movements. It also shows us when price for a financial instrument is overbought or oversold. So this is to say maybe price has been bullish for quite a while now, and we expect to see maybe for a reversal. So we typically use this indicator to try to enter those reversal positions. So if the market was bullish and we see that the price seems to be in an overbought position, we would start to wait for uh, for the reversal and try to look for sell positions. So basically with the relative strength index, it's basically a scale which ranges from 0 to 100. So with the overbought level, which is basically above the 70 level, and the oversold level, which is below the 30 level, which would look something like this. So you would have your line here reflecting price, which is your blue line here, and you have your two levels, your main levels. You have the 30 and you have your 70. So whenever you see this blue line here cross over above to this level here, which is above the 70 level, yeah, it would try to tell you that the market is overbought and you'll be looking for sell positions. Alternatively, here where price is below the 30 level, you would start to look for buy positions since the market would be oversold. So to place this on the chart, you would simply go to see where it says insert, right click, choose indicator, then go down here where it says oscillators, and then select relative strength index. Okay. Here we set our parameters, the 30 and 70 level. Let me choose maybe a darker color. And then you'd place OK. So typically you'd see something like this. With here is indicated here, indicating that price has been oversold. So we would typically be looking for buy positions from this area. Here as well, where price was above the 70 level, just above here, we would try to look for sell positions at this point. So we can also use the relative strength index when trading the strength of a trend. So typically when the RSI, the relative strength index, is above the 50 level, pointing upwards, this can indicate bullish momentum, meaning to say that we would expect price to continue going upwards. If it was facing below the 50 level, we would expect bearish momentum. Going back to the charts. Okay, here we only have the 70 and 30. Okay. Let me try to enter the 50 level. I'll go to indicator, oscillator, the relative strength index. Then I'll add another level. Okay. Here I've placed another one below the current one. Okay. So as you can see, let me go forwards for a bit here in this area where this blue line crossed the 50 level. We would typically expect to see it continue going downwards as it went here. Let me zoom. Okay. So at this point, let me highlight objects. Okay, this level by this candlestick. Okay. Okay. So price was this was a typical double confirmation whereby price was below the moving average or red moving average and was below the 50 level. So for this trade, it typically would have been attractive to scalpers, typically people who enter trades for a short period of time. So they would see this indicator and they would enter their sell position and hold for just a few minutes and then close their trade. We also, with the RSI, we also can trade what we call divergence. So basically, we have what we call bullish divergence and bearish divergence. So with bullish divergence, typically price makes lower lows while the RSI makes higher lows. Whilst at the bearish divergence, price would be making higher highs whilst the RSI makes lower highs. So to further add context, it would look something like this. Here on our RSI, we see that it is making higher lows, whilst above on our price chart, it's making lower lows. So this is a bullish divergence. So whenever you see a situation like this, typically this can be a reversal situation whereby we'd expect the price to reverse from a downtrend and turn towards an uptrend. So you would typically wait for just a bit and look to place your buy positions just above the trend line here. So we also have common mistakes when trading technical analysis. Some people may over rely on indicators without context and also ignore the fundamentals. Because there are times whereby you could place your technical indicators and you might have multiple confirmations, your support level, and maybe you see a, a candlestick pattern which is indicating that price might bounce off of our support level. But this may be affected by the fundamentals. Maybe news might break out that maybe a war has broke out, or maybe interest rates, or maybe other news which affects the financial markets. This can greatly affect technical analysis. So when trading, we highly urge our clients to keep abreast or keep informed of what is happening in the financial markets, as this would also affect how price moves. So also common mistakes are trading based on emotions rather than analysis. So when trading with your technical analysis, typically you want to stick to your trading strategy. If you're using your support and resistance lines or your trend lines or your moving averages, you would have to stick to that. Whenever you see a favorable setup, you would enter your position and enter your stop loss and your take profit levels. This mitigates losses and helps you practice proper risk management. We will also look at trading psychology. So basically the definition of here, this is the study of emotions and mental states that affect trading behavior. Why is this important? This is important because it affects decision making and overall, or the overall trading performance that you would see. So the role of emotions in trading. When trading is a very emotional activity, because especially when you are dealing with real money, you can experience fear, because since you're dealing with real funds, there's the possibility that you could lose your capital, which is why typically we advise clients to use stop losses so as to mitigate this. So this can lead to missed opportunities or premature exits. Also, there's greed, whereby you have been trading for a while. Maybe you're using your small lot sizes and you see profits start to accumulate in your account, and you feel like, I can continue making this profits. Let me increase the lot size. This will overly affect your trading, as this also increases your exposure to your losses. It will be greatly multiplied. So we often advise clients to stick to their trading strategy, depending on their account size, stick to lower lot sizes and continue from there. Hope also affects, as one might hold on to losing trades and hope that they will turn around. Typically, this is very dangerous. And that's why we overemphasize that clients should use stop losses, because there are times when price may continue going in the opposite direction than what you would have intended. So it is good to set your risk parameters, your stop losses, and your take profits. We also have common psychological biases, some of which I was highlighting earlier on. We have what we call loss aversion. This is the tendency to prefer avoiding losses over acquiring equivalent gains. And also overconfidence, as I was saying earlier on, whereby you were trading and you have been making consistent profits and you feel like, let me increase my lot size, let me increase my exposure. We also have what we call confirmation bias, whereby you'll be seeking out information that confirms existing beliefs whilst ignoring contradicting data. So the markets or the charts have a tendency of showing you what you want to see. So if you look at a particular financial instruments with the mindset that this price will go up, maybe due to certain biases, whenever you look at the charts, you would typically look for setups that would confirm this. And this might not align with what the market wants to do, maybe due to fundamental reasons or maybe technical reasons. Okay, we also have for techniques for improving your trading psychology. So basically, you have to build a trading plan and mitigate emotional decision making. Stick to your trading strategy. You shouldn't try to trade based off of emotions. You should just stick to your trading strategy. If you're using your support and resistance lines, if you're using your indicators or whatever strategy that you're using, if it's working, you should continue using it. If it's not, you would need to go back to the drawing board and try to fine tune it so that it may work. You would also need to learn from your mistakes. This can be helped by journaling, keeping track of your emotions and decisions. So this will help you note down where you have been successful or where you have incurred losing trades. So this is more like a reference point whereby you could use it to further improve your trading. So essentially, that's it for today's presentation. If you have any questions, the floor is open.
Thank you, Tiona. Thank you very much for that presentation. It was quite insightful. Yes, as Tiona said, the floor is now open for questions. You can just kindly raise your hand, and then we'll call out the attendee also there who can then talk. Are there any questions? So, Mendes, is that a legacy hand or you've got a question for right now? I see Progress, you got your hand up. I think you can go ahead and ask your question.
Yeah, sure. It's a question. You see, some of us are pretty new in this thing, and yeah, it was quite a mouthful presentation, very insightful. But I just wanted to ask, am I supposed to be knowing all this, or am I supposed to go through lessons and know how to memorize these techniques, all this? There's an app that can help me do this.
Okay, that's a very good question. So you'll find when trading, there are lots of different trading styles that you can incorporate. Some people, these are just maybe your support and resistance levels, what you might in your trend lines, what may be most important for you to take note of. But you can incorporate different trading styles, which are entirely different from what I've shown you. When it comes to applications, there are, at the moment there aren't none that I'm aware of. But luckily for you, on our website we have what we call VCG Grow Academy, whereby there's free comprehensive learning material which is available there, which can further reinforce what you have learned today.
So, Progress, just to add on to what Shona said, to be honest with you, you do have to put in a bit of time in terms of understanding most of the terminology that Shona was trying to express there. As VFX, we're going to continuously have these trainings. For those, I'm sure there are others that have been on most of the trainings that you've been doing. But yes, you do have to put in a bit of work just to learn and understand most of the terminologies that you mentioned. And what we're trying to do is when we have these trainings, we then want you to match what you've read on the site, and then you come onto these trainings, get an understanding, as well as go into the BCG Grow Academy. And we'll also be sharing most of the videos of these trainings that we've done. So meaning you will have a repository of reference back to go and really understand. The other good thing about the VCG platform is that they have what is called copy trading. So if you do have an understanding of a bit of the terminology, not all of it, you will have an idea to then see other traders on the platform who have registered as experts. So you can then simply copy their strategies while it's using the little knowledge that you've got. So you will have an idea of how that person that you're copying is going. And then also the other advantage is there is a demo platform that is there. So you can also then a demo account, and then you can just you'll be getting as you read or as you. But yes, in a nutshell, Progress.
Thanks a lot. Thanks a lot. Quite helpful.
I have a question.
Sure thing, go ahead.
Oh, sure. Thank
Yes,
you.
yes.
I have a couple of questions. Number one, on your platform, I know you talked about stop loss, but do you have a trailing? Am I able to do like a trailing stop loss, or it's only hard stop losses?
You could, yes, yeah, you could actually use trailing stop loss. We actually have them on the MetaTrader 5 application, or
Okay.
you also have the option of manually trailing your stop loss.
Oh, the
So
old
whereby
school.
you see, if you see prices in your favor, you could just continue adjusting your stop loss.
Oh, okay. And the last question was, do you guys offer options trading?
And currently, fortunately for the moment, we don't, but maybe in the future, it's something that we might want to look into.
Okay. That's awesome. That is awesome. Thank you. Thank you.
Sure thing. I see Robin has a question.
Unmute your mic, Robin. If you're talking, you're on mute. We cannot hear you.
Robin, you're still muted.
Okay. You can also type questions in the chat box that's there. You can also type the questions in the chat box that's there. Okay. Are there any other questions? Has anyone got a question?
Mendes, you can go ahead and ask. Mendes, I see your hand is up. You can go ahead and mute your mic and ask.
Oh yeah, I couldn't unmute myself. So my question was, so if I am interested in this, where can I find a link? Because this I can trade when I'm in Zimbabwe, right?
Yes.
Oh wow, interesting, very interesting. And I can also trade penny stocks.
Unfortunately, at the moment, we don't have penny stocks, but maybe in the future.
Oh, okay. So you also have like Zimbabwean stocks over there that are being traded, or it's only forex commodities and
No, at the moment, it's strictly your international products, your currencies, your cryptocurrencies, your commodities, and your CFD stocks.
okay. Very, very interesting. I think I like. I think I like this. Thank you.
You're most welcome.
So then just to add to that, Shawana, Mendes, if you ever wanted to trade local stocks, that's Zimbabwean stocks, that's where we as the exchange come in. We have our direct platforms the ZSE Direct and the VFEX Direct. The ZSE Direct for currencies being traded in our local currency, while the VFEX Direct is being traded in US dollars. So in the event that you wanted to trade both CFDs, but at the same time wanted to trade actual stocks, that's where we as the stock exchange come in. I hope that helps you with a bit of clarity on that.
Thank you. Then that really helped. Thank you.
Right, sure. So I'll add the links for the direct platforms in the chat, just in case you want to visit and trade in some of the options that are there. Okay, so does anyone else have a question? All right, so we've come to the end of our meeting. Thank you everyone for joining. Thank you for taking your time to be a part of this session. We will continue to have more of these sessions every other week, and I will definitely share and remind you whenever we're having the next session. We look forward to seeing you again in the following weeks, and I wish everybody a happy holiday. Thank you.
Thank you.
Thank you very much. Bye.
Thank you, everyone.
Bye.
Thank you. Have a good day.
Okay, thank you. Thank you.